Now we'll discuss about depreciation in details. Actually, you have already learned this lesson in your previous class, but I would like to remind you some points here before you start this question of cash flow statement with depreciation. You know, depreciation means wear and tear on fixed assets. There are different methods of providing depreciation. You can adopt the method of straight line method or reducing balance method, etc. But what I'm trying to tell you, there are two ways to provide depreciation on the fixed assets. Number one, direct, and number two, through provision. Let me have one example. Suppose on 1st April 2010, a firm purchased furniture of rupees 10,000 and it was decided to provide depreciation of rupees 1,000 every year. You know, depreciation is provided on closing. So the closing is 31st March 2011, after 1 year, and you have to provide depreciation. So what will be the journal entry? Depreciation account debit to furniture, 1,000 rupees. So what will happen in profit and loss account? On debit side, you will take the two depreciation, rupees 1,000, and in balance sheet, the furniture will be written as 9,000 because last year it was 10,000. Now the net value is only rupees 9,000. Or moreover, we have lost profit of rupees 1,000 due to depreciation. That's why it is placed on the debit side of profit and loss account. Next year, 31st March 2012. One more year has passed. What will you do today? You will provide depreciation of rupees 1,000. So first of all, pass the journal entry. Depreciation account debit to furniture, rupees 1,000. And this 1,000 will be taken to profit and loss account debit side because we have to reduce the profit. Secondly, in the balance sheet, furniture on asset side will be shown at rupees 8,000 because the last year the value was rupees 9,000 and now its value is only rupees 8,000. Next year, 31st March 2013, today is the closing. Again, you will provide depreciation. So depreciation account debit to furniture account, rupees 1,000. And you will have to make profit and loss account to depreciation, rupees 1,000. And in balance sheet, the furniture will be shown, rupees 7,000. And in this way, after 10 years, the furniture will be zero in balance sheet. And the furniture will be finished. So this is the system. So if you prepare the furniture account, so how the furniture account will look like? On 1st April 2010, to cash rupees 10,000 and on 31st March 2011, by depreciation rupees 1,000 and by balance CD 9,000. So this by balance CD 9,000 will become to balance BD on 1st April 2011. To balance BD 9,000 and 31st March 2012 by depreciation rupees 1,000, by balance CD rupees 8,000, total 9,000. On debit side, 1st April 2012 to balance BD 8,000 and on credit side 31st March 2013 by depreciation rupees 1,000, by balance CD 7,000, total 8,000. In this way, the furniture account will go on till the closing balance of furniture is zero. So we were providing depreciation of rupees 1,000 every year. It was direct depreciation on the asset. Now there is one more approach. We can provide the depreciation. Let's see how it happens. On 1st April, the furniture was purchased for rupees 10,000 and it was decided to provide depreciation of rupees 1,000 every year through provision. Now it's a new thing, through provision. So what will be the journal entry on 1st April 2010? Today you have bought the furniture account debit to cash rupees 10,000 after 1 year, 31st March 2011. You know, depreciation is always provided at the time of closing. So you are going to provide depreciation of rupees 1,000 today. You have to reduce the profit. So the journal entry will be profit and loss account debit to provision for depreciation, rupees 1000. Have you seen that? I have not involved furniture account, I mean to say asset account, or moreover, I have not debited depreciation account, but I have debited profit and loss account because we have to reduce the profit every year for rupees 1000. So what will happen? Today in profit and loss account, on debit side, you will write down to provision for depreciation, and balance sheet. On liability side, provision for depreciation 1000, and on asset side, furniture rupees 10,000. Last year, the furniture was 10,000. This year, the furniture is same, rupees 10,000. It means we are not disturbing the gross value of furniture, but provision for depreciation is being written on the liability side, and we are also reducing profit every year. Now, let's move to 31st March 2012. Today is the closing. We have to provide depreciation, so the journal entry will be profit and loss account debit to provision for depreciation, rupees 1000. So on profit and loss account debit side, we'll write down to provision for depreciation, rupees 1000. It means we have reduced the profit, rupees 1000. So what will happen in the balance sheet today? Furniture on asset side, rupees 10,000, but provision for depreciation will be 2000. Last year we had 1000, now it is 2000. Next year, 31st March 2013, again we have to provide depreciation through provision. So journal entry will be profit and loss account debit to provision for depreciation, rupees 1000. So if we look at the profit and loss account, on debit side, to provision for depreciation, rupees 1000, and if we make the balance sheet today, what will happen? On asset side, furniture rupees 10,000, provision for depreciation rupees 3,000. So in this way, what will happen? One day, on asset side, the furniture will be rupees 10,000, and provision for depreciation on liability side will be 10,000, and we'll cancel both the accounts. In this way, the furniture account will be missing and provision for depreciation account will be missing. But in both approaches, we have reduced the profits by rupees 1000. The only difference was that asset was being shown at the gross value till its end when we are providing depreciation through provision. But if we provide the depreciation directly, the value of the asset start decreasing in the balance sheet on asset side. Means we show the net value of the asset in the balance sheet. So this is the main difference.